Sell in May and go away. The June swoon. The Santa Claus rally. When the VIX is high, you buy. When the VIX is low, you go. Well, okay, that last one actually is not so popular, but you've heard of these phrases that we use in the stock market, right? Sell in May and go away till Labor Day. That's the official one, but most people don't know that. Little fun fact for you. When the VIX is high, you buy. When the VIX is low, you go. Tonight, we're going to talk about what to do and talk about the existing market as well, how things are going. But what to do when you're investing for the long term and volatility, which means the market gets wild, typically to the downside, picks up. All of a sudden, volatility gets a little crazy. And I'm going to start, first of all, I hope you're enjoying a drink. I've got the Broken Barrel here tonight. I forgot my Flaviar thing. I'm going off topic, I know. I got a new one of American-made whiskey. I had a whole speech prepared and everything about America. And I forgot it at work, the actual drink. So we'll start with that tomorrow. But over the course of your investing, and actually the next month and 2 months, you're going to have to get used to volatility. We can actually tell when volatility is going to go up, when people are betting that volatility will go up. And of course, there are the quiet times. Midsummer tends to be a quiet time in the market. There's seasonal effects there. But when you're investing for the long term, you've got to know that there's going to be moments where the roller coaster is like out of control. And you're like, who's running this thing? This is crazy. But most of the time, it's just going to be slow and boring and steady to the upside. If we can get you to not make mistakes during the volatile times, awesome. Now, we're financial advisors here. Most of you know that. And I like to point these things out ahead of time. I'm going to share something with you here to give you an insight as to where the market stands at the moment. None of this is my opinion. I don't like sharing my opinion for fun. I'll tell a joke or something, but I like to use data so that you can disagree with it, but that's the data, right? So where we stand right now, you're watching this video here in the near term. We're at the end of April 2023. We're going into May. Now I'm going to pop on over here. And this is the expected and currently being bet on volatility for the S&P 500. So in the month of May, which we haven't hit yet, are we going higher or lower? Volatility is higher. Now, to be fair, what this is not an assumption. It's not a survey like I mentioned on the closing beat. This is based on the VIX futures butterflies. So if you're really, really into it and you want to get geeky, it's the price of the current monthly contract minus the average price of the previous and the next contract to come up with May. And then for June, so if you're familiar with futures, we don't just have one set month. We're not operating in the present like we do in a stock or an ETF or whatever it is. So futures have various expirations. If we look to June, that'll be a light blue line here. Volatility expected to be higher. Now, this is the pricing of that in that respected expiration. So this is not someone who is saying they got a call from CNN and they go, yeah, I think the market's going to be more volatile. And then they called somebody else and they said, yeah, I think it's going to be volatile. This is actually people placing their bets in the futures market. So big money being played here. So in other words, we can see that through May, the dark blue line, June, the light blue line, we expect higher volatility. People are already positioning for that, making bets. Now, as we get to July, okay, a slight increase relative to the short history here, I guess. And then August, we expect volatility will start to calm down. That's that late summer performance. So in the next 2 months, we've got to expect that volatility there. At least, it might be wise if you do there. So some of the basic answers that an advisor can give, it's cute, but have a long-term perspective. Right? They actually teach you that to tell clients that, like pat them on the back and give them a cup of coffee and tell them to have a long-term perspective. Okay, that's got to be in the comment there somewhere. But keep in mind, you will likely see many, many 10, 20% declines, many 10% and 20% rallies We just don't think of the rallies. We get all excited about those, right? We don't have that same emotion there. The other thing I want you to think about in volatile markets is it just a volatile market or is it a bear market? All right? A correction, a bear market. A correction would be 10%, a bear market would be 20%. So if it's just volatility, well, there's any number of things that can cause that. The Ukraine war, the China trade tariffs, the tariff tantrum or whatever they called it back then, an election, a new bill passes, somebody of significance passes away. These things cause short-term volatility. Well, that's one thing. That's just temporary interference in the normal pattern of the market. If it's a bear market or something worse, okay, that's where you want to really make sure ahead of time that you're positioned correctly and everything's good there. Speaking of being positioned correctly, being diversified, that's the key word, that's your buzzword advisors like to use. When someone or another advisor tells you, you need to be a little bit more diverse or diversified, ask them to be more detailed, because diverse doesn't mean not correlated. So as I was mentioning on our Closing Beat show, you can be invested in the S&P and you can be invested in the NASDAQ. Okay, you're diverse because you're invested in two different indices essentially, but you're not spreading out your risk. They will move together. Now, as I have shown in the past here, and I could probably just show it here today, you can be in the S&P and oil, for example. I don't know why you wouldn't do this, but as an example, you could have S&P and oil, and they won't move together. They're not correlated. So when one has a bad day, you're not going to see the same thing having a bad day or your other investment. That's interesting in a bear market, a volatile market, a correction, because we don't want all your investments going down. So if an advisor says, we should review your portfolio and make sure you're well diversified, come swinging with that question. I might be diversified, but can you explain the correlation between my various investments? Am I highly correlated but still diverse? Or am I not as highly correlated and still well diverse? That's what we want, right? So that's a little geeky one there for you. All right. The other thing, don't buy. So have you ever heard of portfolio insurance? It's effectively buying the VIX, participating in a VIX ETF. It could be buying puts in the market or on an index or on a stock. It could be buying an inverse ETF. Don't fall for that stuff. It is all a costly way of just simply moving a few dollars to cash, right? You're paying to protect 1/3 of your portfolio or hedge 1/8 of your portfolio, when in reality, for free, you could just take 1/8 of your portfolio and put it in a money market account and actually have a net positive return. So if you're going to go down that route and you can't be convinced otherwise, don't buy the insurance there. It's just an expensive way to learn a lesson from experience, right? Which brings me back to when the VIX is high, you buy. When the VIX is low, you go. That's actually, I just stole that directly from a guy on the radio here. I happen to like him back in the day. I think he's out of Sarasota. I would listen to him while I was delivering menus to restaurants as a kid. He might not still be alive, but it never took off. He's not like a Jim Cramer. When the name hits me, I'll remember. But that's awfully disrespectful. It just won't hit me what his name is. When the VIX is high, you buy. When the VIX is low, you go. My God. I'll put it in the description if I remember, because I feel like I need to give credit. Well, that saying didn't take off, but it is so true in the general sense. You want to tell yourself, if you're going to follow anything, follow the VIX. And the simple thing is, when the VIX is high, well, that's when you want to be buying stocks. That's when Warren Buffett buys stocks, by the way. You can actually track that. When the VIX is low, you go. That may mean you take a piece off your portfolio. You decide to take a little less risk, of course, looking at your plan. And I just want to show you what that looks like. So here I've plotted the VIX. I'm using the VIX index from the CBOE so I can go back further in time, 1990. The actual VIX futures only go back to 2004 or 5, somewhere in there. And of course, VIX ETFs didn't appear until later on. So if we look at the S&P, this is the actual movement of the S&P since 1990, and we compare that to the VIX. Now, there's no magic number here. There have been studies done on this, and of course, you can you can kind of fine tune this, but here's the VIX in orange. Right here, is it high? Right here, is it high? Is it high? Right? Yeah, I would say it's high relative to itself. It's high, it's high, it's high. If when the VIX is high, you buy, you often can't go very wrong. You're very close to buying at the bottom. You basically bought the bottom. You bought in the middle of a big uptrend. Maybe your dollar cost averaging, you added some more. Nice. When the VIX is high, oh, right here. The market is basically at a bottom, very close, good enough, right, for a long-term portfolio. When the VIX is high, now maybe not as high, you could zoom in and make this look like it's not high, but it's high, right? We're not trying to pick an exact point here. When the VIX is high, you buy. When the VIX is high, you buy. Just keep sliding over. When the VIX is high, high, high. That's COVID, so that's a bit of an outlier. When the VIX is high, you buy. Can you find any instance where that didn't work? Here's the problem with this. I'm going to go like this and go show recessions. All right, so let's go like this. When the VIX is high, oh, you see the gray in the background? When the VIX is high, it happens to be at some of the scariest times. When the VIX was high, higher, highest, it's at some of the scariest times. The market is falling apart. But in hindsight, don't you look at that and go, man, if I could go back in time and I could have just bought when the market had fallen. Yeah, you say that now. But during that time, you're like, I don't know, man, gold's the way to go. The world's over. That's it. Build my bunker. Let's do it. I mean, I've done this with people, thousands of people over the years. So I get it. But now when we look back in hindsight, when the VIX is high, you buy. Suck it up and dollar cost average, get in there, put $1 in for all it matters. Take advantage of the fact that volatility is high. Now, I'll wrap it up by saying, where's the volatility right now? Can I just do this like this? There you go. The VIX is not high by any stretch of the imagination. This is sorted over a 1-year period. Let's go over a 3-year period. Is the VIX high? No. It's low. We're down here. What's the saying? When you go low, when the VIX is low, you go. You don't do anything. Go away from the computer. Don't buy stuff. So we look down here. Zoom out even further. Is the VIX high relative to itself? Absolutely not. Let's go out 10 years. Is the VIX high relative to itself? Nope, not even close. And then where we just were, zooming out as far as I can go. Is the VIX high? No. Okay, it's not. So what's the attraction right now to buy the market? There's not very much attraction, I'll give you that. However, there's no reason for you to make massive adjustments. The VIX will go higher at some point. It's never just going to stop. So you will walk into a volatile market and you will be presented with both the fear of it falling and the opportunity of what could be. So I want to point that out for the long-term investors. Don't do it. Don't get yourself in trouble. That's one of the ways that I like to think we add value to our clients, is stopping you from doing the silly things. I might have to close your eyes and tell you to turn away for a little bit, but if I can get you through it, nobody has ever complained to me that that was the wrong thing to do. All right. Enjoy. We will be back tomorrow. I hope you enjoy the rest of your evening, and didn't even get a chance to really hang out with you here for a minute. Maybe we'll do that tomorrow. All right. Adios.